Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. I missed out on probably the biggest ETF and crypto story of the year last week.
It was a real crossover story.
But it's so big that I think that story continues.
I think so.
Into this week.
I think it's fair game.
So let's get to the biggest stories in the now more than $10 trillion global ETF industry. I am talking, of course, about the grayscale victory over the SEC. When will the U.S. see its first Bitcoin ETF, spot Bitcoin ETF, actually launch? We'll discuss.
And traders boosting their bets on a November Fed hike after a strong reading on the U.S. services industry. What funds investors should look into in this higher for longer environment?
And we're going to discuss as well the trends of launches. There were a lot last year, and closures, maybe more to come this year, with the president of the ETF sub-advisor, Vident.
And Matt, as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Matt, thank you. So I've got some good news. We've seen a slump in the interest for equity ETFs over the past couple weeks as the summer ended, but we've got a bit of a bid back for those funds. You see at the top is VU and the Qs, and those two are important for a reason. VU is used by retail, the Vanguard bid, $3 billion, that's a lot. By the way, VU now at $29 billion year to date. That is double any other ETF. Vanguard, again, on another level. The Qs, though, that's used by the trading crowd. So you like to see $2 billion come in there. Look at the 1 month is still negative. So again, people are coming back into the Qs after that good week last week. Also notable on here, XLE at number 9. Remember, energy went away after that huge rally. Now it's back. It had a really good summer. We just wrote about PSE, which is small cap energy ETF, but XLE getting more of the flows there. Let's look at the outflows this week, and we can see that small caps on top again, not great. IVV. So again, this isn't all like great news, but largely speaking, it's net positive into equities. RSP seeing outflows is interesting because that's equal weighted S&P. That's been seeing bids all year. Many people are now going back to the Super 7 trade. We'll have to see about that. Now, let's take a look at our chart, our proprietary chart of our ETFs used by traders versus those used by the buy and hold crowd. Because I said earlier, we got VU and the Qs in the top, and the orange line here is the buy and hold crowd. So you can see all year they do their thing. They invest in the market relentlessly. The white line, a little all over the place. They came in this summer, but then the past couple of weeks they've been out, right? They've sold out, nervous, afraid, but look, this last week, that white line there. What you want to see if you're looking for bullish sentiment is both lines up. That means the retail and the trading crowd are both on board. So I declared the summer was over for equities, but I think I spoke too soon, Katie. I think the summer can keep going a little bit.
All right, we appreciate a correction, a clarification, if you will.
Yeah, absolutely. We'll continue to keep you honest on that, right? We'll timestamp this and talk about it throughout the year. Joining our conversation now is Jared Woodard, head of ETF strategy at BofA Securities. And Jared, I'll just ask you, your take on what the ETF world is like for equities right now, or what equities are like for the ETF world. How does it look to you?
Well, it's been a year in which investors have been relentless buyers of a lot of things, including equities, including government bonds, I think is the biggest surprise of all, Matt, because despite the fact that Treasury bonds, just saw their worst years last year in a very long time, despite the fact that Treasuries are down another few percentage points so far this year, you've seen relentless buying of Treasury ETFs. You've seen buying in equities, too, as people pile into tech stocks, growth stocks, artificial intelligence, and so on. I think I appreciate the chart you all just looked at comparing individual investors and folks who are maybe more active, because I think watching those flows and watching where you see divergence in particular between the returns in an asset and the flows in that asset can be a really valuable indicator of where sentiment is the strongest.
Jared, let's meditate on what's going on when it comes to the Treasury market, though, because like you said, relentless buying. Just to put some numbers to that, if you take a look at TLT, it's down 4.5% on a total return basis so far this year. And then you take a look at the flows. It's taken in over $15 billion. That's the second most of any ETF. What's the thinking there? Why do people keep just slamming money into this fund that continues to lose money?
Hey, I think a lot of the story has to do with expectations throughout this year for some kind of recession. Expectations that the Federal Reserve would stop hiking interest rates and would start cutting rates next year. If that's your view on the future of the economy, then arguably it makes some sense to be accumulating long-term bonds and other long-duration investments at these levels. If you don't share that view, If you think that there's a risk that inflation resurges the way that we think is a meaningful risk, if you think that the Fed is going to be higher for longer, that we're on the cusp of maybe even of a structural shift higher in inflation and interest rates over the next several years and decades to come, then some of these really aggressive moves into Treasury bonds, especially long-term Treasury bonds, might prove to be a bit early.
I'd like to move to another thing that was in your notes here about emerging markets. And this is something me and my team always debate and discuss. You know, emerging markets look good, right? But let me take you to the past 5 years, end of last year. Emerging markets was negative 3%. The Qs were up 91%. That would also seem like a good time to go into emerging markets. But this year, the Qs are up 42%. Emerging markets only up 4%. It seems like even though EM and international can always seem like a good trade valuation-wise, the U.S. just rules, and the innovation here is unparalleled, and it just keeps winning. So just, I guess, give me your take on EM, given all that.
Well, Eric, I think the most important decision from our perspective when it comes to emerging markets is that investors treat emerging markets as a place to try to capture growth, and maybe a different sort of growth, maybe real economic growth as opposed to digital assets and new technology. But when we think about emerging markets, we think about strong demographics, strong growth profile, companies that are modernizing, economies that are modernizing. And when you start to think in those terms, then some of the emerging market products that investors have used for years don't look quite as well structured. I mean, in particular, we think that investors should treat investment in China as a separate investment decision. Maybe you want to be there, maybe you don't want to be there. That's a separate conversation from our perspective, because the Chinese economy, whatever its merits, whatever its demerits, it's a very different beast from the rest of emerging markets, which still have those traditional growth profile. We think that emerging markets ex-China is an important place to be allocated. These economies represent 30% of world GDP. They also represent less than 8% of the allocations in most portfolios that we see today. That means there's a huge differential between the kind of growth that's happening in the world, the places where it's happening, the places that have a strong demographic profile, strong growth profile for the future, and the places where investors are allocating money. So it's not just about valuation, which you mentioned is a very important argument in favor of these economies, but also the fact that they can be genuine diversifiers against concentrated holdings, maybe in U.S. tech. We look at a fund like EMXC for emerging markets ex-China, which has attracted really substantial flows over the past year or two at the same time when investors have been pulling money out of the Chinese economy. And you can see not just those flows, but you can see the big differential when you look at total returns.
Even if leaving aside the fundamental issues of EM or not, how important is fund construction? Because you could pick from a number of different ETFs that all have the same aim, but don't show the same results.
Yeah, it's a great point. Fund construction, we think, is absolutely essential. Not all ETFs are created equal. And it's not just a story in emerging markets. If you look at artificial intelligence, the big theme of the year, a fund like AIQ has outperformed a lot of its peers, has outperformed BOTZ, one of the other artificial intelligence ETFs, I think by 14 percentage points just this year. If you think about something as familiar as defense stocks, the other extreme maybe of the growth and value profile, defense companies have seen some strong returns. A fund like PPA has outperformed this year. One of its peers, ITA, we look at, I think is lagged by 400 basis points or more. The common thread among all this is that fund construction is incredibly important. In the cases of these funds I've just mentioned, a lot of it has to do with whether a fund is allocated on a more equally weighted basis or is more focused on market cap and some concentrated holdings. Our analysis suggests that avoiding too much concentration, spreading that allocation in a more equally weighted way has been a long-term winner.
Jared, awesome having you on the show. Hope we can get you back. Jared Woodard there of BofA Securities talking to us about fund construction, EM, and a lot of other ETF issues. Coming up, we're going to talk about what the future holds for a possible spot Bitcoin ETF and what has unfolded since last week's fascinating court ruling. Victorious grayscale over the SEC. Regulators continue to encounter setbacks. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with cash. Overall, cash-like funds, of course, this is ultra short duration funds. They took in nearly $2 billion in August. That is the biggest monthly haul going back to February. You can see that cash kind of came out of favor over the summer, but it's back now as we head into the final quarter of this year. So cash is hot. So too are Indian equities, at least if you judge by this ETF. EPI is the ticker. It led EM inflows last week. Of course, this is an ETF tracking Indian equities. You can see that those inflows really starting to build. Of course, too, as China falls out of favor, that's putting a bit of a shine on India. Let's also talk about one of the biggest stories in both the crypto and the ETF industries right now. That is Grayscale's legal victory over the SEC. We spoke with VettaFi financial futurist Dave Natick last week about what the process could look like from here.
I think most folks are thinking that we're going to have some sort of common clock restart, and we'll be looking at something like the first quarter of next year before we get an actual approval. And at that point, I do think it's a horse race, and I do think cost matters.
All right, let's talk more about this issue. I read the stories from the beach in Valencia, but I couldn't think about anything else.
No.
I mean,
certainly
amazing.
not your vacation.
No, well, it was less of a vacation and more of a babysitting week. But James Seifert of Bloomberg Intelligence joins us now to talk about this. You know, one more disappointment for regulators and one more victory for crypto. Is this going to change a lot? Because I saw an incredibly muted reaction in prices.
Yeah, so, I mean, based on what Dave said, I agree with like 90% of what he said. I think Q1 is possible and even likely. Eric and I are very much on the record. We think it's going to happen before the end of 2024. But I'll throw out an earlier date. I think mid-October we could see approvals from the SEC here. Not guaranteed, but it's kind of likely in my book.
Does approval mean launches? What does the timeline look like?
So the timeline is hard to know. I mean, Grayscale wrote a letter yesterday, and they basically were saying, hey, SEC, give us a call. Like, what do we do next? Let's have a meeting. Let's figure this out. So even Grayscale doesn't know what's happening. I don't think the SEC knows exactly what they're going to do next. Or if they do, they haven't made it publicly available for us to know what's going to happen. So timeline, not really sure. Theoretically, even if they approve in October, they could say we want to wait till this date. I do agree fully with Dave on the common clock theory. I don't think the SEC is going to give this to one issuer, one person, and going to say, here, go ahead, have at it. You have the only spot Bitcoin ETF for a few days or a week. I think they're going to launch either all of them or allow all of them or allow at least multiple to launch on the same day.
Here's what Grayscale's CEO, Michael Sonnenschein, had to say about this lowering fees as well, which is a huge issue.
We are committed to lowering fees when GBTC converts to an ETF. We'll obviously have to come back on and talk to you about what the fees are when that conversion actually happens. And
I know because I was reading Katie and Vildana's amazing coverage.
Thank you.
Vildana Heinrich writing a lot of those stories with you. They get like 2% right now, and they've got to cut that to like, what, 30, 40 basis points?
Yeah, I mean, who knows exactly where they're going to go, but we think 50 bips is likely at least. Like, it's going to have to go down that low. Look, Grayscale's raked in billions, if not billions, hundreds of millions of dollars over the years, right? So they've done just fine. But what they've done, what they've used that money for is they used the money to fight the SEC in court. A lot of people said it was frivolous, they were going to lose. They won. Now we're sitting here trying to figure out what happens next. I think it's about time. It's always been their plan to cut fees when they launched an ETF. They told me that in 2017 when we were talking about trying to do this in 2020. They've been saying they're going to cut fees as soon as they can get an ETF. So we'll see when it happens, and I would expect them to cut fees, and it's going to be a race to the bottom. Everyone's going to have to try and differentiate, market themselves as better than the others. I don't think there's really a need for 8 or 9 or 11 spot Bitcoin ETFs in the U.S. marketplace.
And you think about that race to the bottom, of course, they're up against, what, BlackRock, Invesco issuers who are very comfortable fighting fee wars. But
you pointed out somebody has an S&P tracker that is like 2 basis points.
Oh, yeah.
Right?
I believe that's State Street, right? So,
Yeah.
I mean, we're talking about virtually zero at that point. So we'll see how far this goes. But when it comes to this horse race, the common clock idea, of course, we talk about all the time how the first mover advantage is really important in ETFs. Is Is it as important when it comes to the spot Bitcoin ETF race when you think about the fact that Grayscale already has billions of dollars of assets?
Look, there's also this theory out there. One, I do think it's as important because if one other issuer gets to come out, they're an ETF and they come in a way lower cost than GBTC. One, I think it'll siphon money away from other products around the world and products in the US. And two, like there's just no way to know exactly where the money's going to go. A lot of people think like GBTC is going to see this mass exodus of capital. I do think there's going to be some outflows, but for the most part, people aren't going to sell. They have tax burdens if they decide to sell this thing. They'll end up benefiting from it converting. And if GBTC does what it says it's going to do and lower the fees, there's just not as much demand to sell. So while I do think there is going to be a lot of money coming out of GBTC, and there's no way to know what that impact will have on Bitcoin itself, I do think this idea that GBTC is going to go down and only have like a couple $1 million in it is just ridiculous. I think maybe 20% of the assets might come out and go somewhere else, but I don't think we're going to see 50, 75% of the assets leave Grayscale.
All right, well, we're all going to have a very fun fall. We're going to be talking with you a lot. That is James Seyffert of Bloomberg Intelligence.
And tomorrow, remember, they've got a webinar.
They do have a webinar.
Eric
I did hear about
Balchunas and James Seyffert, they have a virtual event. Eventually, they're going to start a weekly vlog.
I look forward to that. Yeah, if you could just live stream all the time, that would be great. But in any case, stick with us because still ahead on this show, we're going to look ahead at launches and closures in this market with Amrita Nandakumar. She is president of Vident. That conversation up next. This is Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down. But Eric, it's a little bit different today.
It is, Katie, right? So instead of looking at one ETF, we're going to take it and zoom out and look at all the launches and closures over the past 5 years. So this is launches to closures. You can see where that gap normally exists, right? Got a little close here, right? Naturally, after COVID. Then it really widened out as about 400 ETFs launched last year. But then closures kind of ramped up a little bit, although now they're on their way down. And you can see launches are coming back as the equity markets have rallied. Also, one fun fact here, Katie, for you. These ETF launches over 5 years represent half of all ETFs on the market. So half of new ETFs are under 5 years old. That tells you how young the market is still, because all the flows come here. Also, interesting, of the launches this year, this is also a shocker, 70% of them have been active. That is crazy considering active makes up 5% of the assets. But they also are having a renaissance, and a lot of managers have been waiting on the sidelines with their active strategies. Now they're jumping in because they see success. Only 30% passive because it is tough to compete with BlackRock and Vanguard over here. This is where the action is going forward, Katie. Look for more active ETF launches.
Eric, thank you. Joining us now to discuss all of this is Amrita Nandakumar. She is president of Vident Asset Management. That is an ETF sub-advisor. And I want to dig into basically everything Eric said. So let's start at the top. When you think about launches, they've definitely cooled off this year. And when you think about the market environment that we're in, how difficult is it to bring a new ETF to market right now versus what we saw maybe over the last 3 years?
Well, first of all, Matt, Katie, Eric, glad to be back. Thanks for having me. You know, the truth is 2022 was a challenging year for asset managers, right? And we see some of the aftershocks of those challenges continue, whether it's ETF investors or ETF sponsors. In this case, a slowdown in launch activity, as you pointed out, as everyone's trying to recover and see what's coming next. But as a firm that partners with ETF issuers looking to bring their ETFs to life, we are seeing this cautious optimism. At the same time, we're also seeing a willingness to cut losses a little bit more quickly and redirect those efforts towards funds that are working or funds that issuers think should be working. So I think in this environment, again, it's expensive to launch an ETF to begin with, but you really need to make sure that you're bringing something differentiated to market, as well as really identifying who your core investor base is going to be early on, and maybe even before you launch. So then those early days of launch, your fund is trading, you're building volume and liquidity, and you're gaining interest from market makers.
Does it have to be active? I mean, Eric showed the huge slice of the pie of launches that are active. Maybe it's because we talk about active ETFs on this program every week, but
correlation.
But you can't earn any money on passive anyway when you're competing against people that have 2 basis points fees. So does it have to be active?
I don't think it has to be active, but I think you pointed out and Eric pointed out earlier, the willingness to compete with the so-called big three, it's just not there anymore, right? As it is, the margins on ETFs tend to be lower than mutual funds or SMAs or other top types of products. And then to come out with an index that's truly differentiated at this point in the game is much easier, is much harder than actually we see in real life. And so active managers are coming out and saying, well, my strategy is differentiated. I might even have a captive investor base. And so let me put my special sauce or my secret formula out there and see what I can do in terms of asset
this is an anti-woke ETF, and I've got a whole bunch of Trump voters ready to buy it. And
so there's certainly a pool of asset issuers that I think would agree with that sentiment.
I was just thinking of one.
There's one, one that I think the news came out today about Strive, right?
Yeah, and let's talk about that, because you're saying anti-woke, probably not going to make it long-term. Strive has $1 billion. That's a big feat for an indie issuer in the past year. They did have some big investors lined up. But whether anti-woke or ESG, I think you have the same challenge. How do you dislodge Vanguard and cheap beta from the core? So I think they're two sides of the same coin with the same struggles. What say you?
I think that's right. I mean, I think investors have spoken time and time again, right? We've all heard the phrase, people vote with their wallets, but I'm not sure that's necessarily the case when it comes to ETFs, right? Whether you have these ETFs that track the political holdings or the holdings of members of Congress, Nance and Cruz, or K-pop or psychedelics, all of these fads, I don't think investors see these as serious portfolio allocations, right? If an investor is very passionate about a cause or about a politician, they'll direct their efforts and direct their funds accordingly, but they're not going to do it in an ETF. So at Vident, we're a platform that allows investors to express their investment views, but when it comes to these very specific, I wouldn't even call them themes, but really fads, hot sauce, we tend to be skeptical.
So I think that's your whole portfolio, right? K-pop and psychedelics.
Yeah. Sounds like a good weekend.
BTS. Anyway, thank you so much for coming in. Amrita Nandakumar of Vident talking to us about launches. Programming note that next week we are back to our normal time, 1 p.m. Eastern on Monday. And if you can't get enough of ETFs, reminder you can listen to Eric and Joel Weber's podcast, Trillions. It's bi-weekly, covering the industry. That does it for Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld and Eric Balchunas. And he has, with James Seyfert, a webinar tomorrow on spot Bitcoin ETFs. Definitely go to Bloomberg Intelligence and catch that. This is Bloomberg.